when and how should you start engaging with investors? Is there any particular point in time, or is it never too early?
I guess that's a really complicated question because it's going to depend a lot on everyone's circumstances. First off, I'd say first off, Jonathan nailed it. It's almost never too early, and I mean, especially with VCs, one of the famous things I think Brad Feld said was VCs like to invest in lines, not dots. And some of the most effective pitches are when someone approaches you 6 months, a year before they're actually looking to raise funds, and say, "This is what I'm going to do. This is my plan, and I'm going to touch base later." So then they come back in a couple months, you have coffee, and they say, "This is what I did," and it's even more impressive if it's what they said they were going to do. But either way, you can sort of build a relationship over time, and once you get to know the person, it makes it a lot easier to invest, for starters, and it makes it much faster to actually facilitate the investment process. I guess going back to just the generalized question then is I think the first thing before you actually start approaching any investors is to decide what the appropriate investor is. And there's a wide range of things, and just like Simon said, a lot of VC ideas aren't really VC ideas. My first piece of advice as a venture capitalist would be, if you don't have to, then don't seek venture capital funding. And seriously, and if you do, you need to have the right sort of business for it. So it has to be a swing for the fences type idea. And there's a lot of very, very viable, fantastic business models that don't need venture capital funding and probably would be worse off with venture capital funding as well. So it's a matter of looking inside your business and really understanding what you need, and then looking across the whole range of investment options. Everything from seeking professional investors all the way to putting the mortgage on your house and using some debt financing for it. And that's really something that is a very, very detailed exercise which we can't get into right now, but I advise everyone just to think about that really, really carefully.
Yeah, I would say there's almost, I said so earlier, it's like a matrix. There's location, fund, stage, size. You really need to think about where you are. In this room, there's going to be people who have kind of already been successful entrepreneurs and are back for a second and third time, and you have a black book and you've done it a few times. It's like when you've gone down a water slide park, it's very scary, but you've done it a few times, it's cool. There's other people who are just completely new to all of this and need complete support from the get-go. We're paid as a corporate finance advisor to avoid drinking cups of coffee and wasting our time because we're on the clock, like the lawyer's on the clock. So, the more you can research and do your homework and work it all out for yourself with a little bit of guidance, then, you're going to save a lot of time in the long run. Not all funds are suitable. VC, you're 6 months, a year away from. There's a lot of things you can do to move downstream to secure an angel or look at crowdfunding and so on. So, again, we're paid to, I've heard the term being investment ready. Get your business plan, know the team, work out the gaps, get a valuation that sounds credible, know your product and market, know the size of it, show ambition and have a great story. These are all things that's going to take you 6 months to a year in realistic terms to crack before you even sit down and talk to an investor, realistically. And I think, it's frustrating when people phone us up and say, "Hey, we're ready," and then we look at the whole thing and say, "Well, actually, you're not, and you're 3 to 6 months away from being ready." Calm your boots, go and get some money. There's no free money either. You have to pay an advisor, you have to pay a lawyer, you have to take time away from the business, you have to basically hire in experts. There's arrangement fees on the back end of the deal that VCs are looking for, that due diligence companies are looking for, and so on and so on. You need to weigh all this up before you launch in. It's not just a question of, I finish my business plan, I'm going to go and raise £1 million in a few weeks. You're just dreaming.
Yeah, the corollary is how late can you start? It's not only how early, but it's also how late.
You need to do all of it simultaneously. There's multiple tracks going on, and you're going to be very busy. And the other great thing is you can't do it all on your own. Our biggest challenge is managing the CEO, the ego, the expectation. There's guys out there who think their business, a few weeks, a few months, a few years even into it, is, there's what I call the kind of baby bloomers, 50 odd, pension's probably not as big as it should be, who's out in the market, this is his last chance at the big time. He's holding on very tightly. On the other end, you've got the young bright upstarts who come in and think they're the next Facebook. So, you've got to kick those guys into shape before you put them in front of guys like you, frankly. Because if they can come in and it's not real, and they're not really incredible, then we fail in our job, and they ain't going to get the money.
Stuart? Okay, so one of the things that's interesting is we've been talking about VCs, and there's this sort of, we've been pigeonholing VCs as somewhere up there at the top end of the market. So personally, I don't talk about VCs. I talk about funds, that's collective investment vehicles. And they range in size from very big to very small. And there are funds out there that would invest in a startup, for instance. The other thing to think about is, and these two guys have already said it, is it depends on where you are with your business. You know, the first investor in your business is you. The next investor is probably friends, family, fools, the 3 Fs. You know, then you've got to go for seed capital from somewhere, whether it's crowdfunding, angel groups, people you know, someone you bump into. Then you're going to move up to the next category of investor, which is probably going to be one of the junior funds, the SEIS and EIS funds. EIS, by the way, going up to 5 million, don't forget. Then you're going to move up beyond there to what people traditionally call VC investment. It's a continuum, it's not a discrete thing. The only thing I would say is, whether you realise it or not, you are pitching for investment from the moment you start your business.
You never stop, do you?
No. You know, if you're trying to employ someone, you're getting them to invest in your business. You're trying to sell to someone, they're investing in your business. You're trying to get equity financing, they're investing. You're trying to get debt in, they're investing. Everybody, including you, is investing in your business. So just get it right. Learn, listen, pitch continuously. Develop relationships. One of the best things I've ever seen, and I've worked in a family office and I've run a fund, done all those things, is the guys who come up to you and say, we're not quite ready for you yet, but I'd like to tell you what we're doing. And they're pitching for the future horizon, at which point they are ready for you and you are ready for them. And I will give them time. I will listen. I won't spend 4 hours listening, but I will listen and hear and remember. And that's a brilliant strategy. It doesn't take very long. But you've got to be able to say in 30 seconds why you're investable. If you can't do that, go and find yourself an advisor who will tell you how to do it.
Business begins with a pitch and ends with a pitch, and you never stop pitching in between. Really, Bank to the Future was a book that I wrote on what I thought the future of finance would look like, which turned into a YouTube video. And in that YouTube video was a pitch that got lots of attention, and from that pitch, it enrolled some people to want to join the mission. And from pitching it, we realised we were pitching the wrong markets and we had the wrong product. And that finally turned into putting some money into some technology. And then when we built some technology, we continued to pitch, and Richard Branson endorsed us, and then it launched, and then we pitched to some customers, and then we pitched to some investors, which didn't work out, so we pitched on our platform and raised finance through our own platform. And then, it just continues, and then we're pitching for employees, and it's just a pitch and a pitch and a pitch, and it just never stops. But I'm actually a big believer. I came from the world of helping venture capitalists exit their companies onto stock markets, and I really do believe in the corporate finance vision that you want to plan out your 5 year through to whether it's 10 years or 5 years, and really put target valuations along the way at which points you're going to raise finance from different sources. And I'm a big fan of really planning it out. It won't work that way. Your business plan will never happen. It will never actually turn out that way. But I think it's important to start pitching for the funding you need at least 6 months before you need it in the bank, if not more. But yeah, you never stop. Long way of saying the same thing everyone said.
And when you've raised all that money, you'll be like the guys at Pro Founders, and you want to stick the money you made from your exit and your success back into your own fund, and it'll all start again, and you'll be on the other side of the table. And then you'll die one day. But the thing is, it'll never end.
Leading on from that discussion, then.
That's actually an excellent point, though, with the 6 months too. Yeah. We should focus on a little bit, because we didn't throw down many actual numbers there as well. As I completely agree. 6 months is, say you're a founder trying to raise some cash. How long should you start at the latest? You say, man, I've got to get going. I've put it off for too long. When can I start? I think 6 months is actually a great number. And don't forget that the absolute bare minimum that anyone really does it in. If you're doing a follow-on round with someone before, I'd still give it 3 months, and that's because just the logistics of closing these rounds, working on the details of actually getting all the documentation signed, things like that, the negotiation period, those collectively, at least 6 weeks, month and a half, 2 months to do that. And if you don't start with at least 3 months in advance, that only gives you, even then, a month to pitch. So I think 6 months is a pretty reasonable number.